In times of financial pressure, confusion can enter the fortress before collapse ever reaches the walls. Income arrives, but disappears. Debt may promise opportunity, but every obligation still demands payment. Before choosing what to buy, the market warrior must understand what is entering the fortress, what is leaving it, and what must be protected. This is the Robert Kiyosaki Financial Literacy Field Guide, an independent study of cash flow, assets and liabilities, income, debt, business ownership, and financial education. This is not a biography, an endorsement, an affiliation, or a recommendation to adopt any financial philosophy without question. Robert Kiyosaki's books and publicly available educational work enter this war room as one independent source of study. The concepts will be examined, compared, and placed behind the gates of risk awareness, discipline, and capital preservation. The archive is open. The first task is not to pursue another opportunity, but to examine the financial fortress already under your command. Segment 1. The Financial Fortress. Before the market warrior studies an investment, before considering a new business, before borrowing capital, or searching for another source of income, the warrior must first examine the territory already under control. That territory is the financial fortress. It includes the income entering your household or business, the expenses leaving it, the assets you own, the obligations you carry, the reserves available to you, and the systems that either strengthen your position or quietly weaken it. Many people begin their financial education by asking, what should I buy? What market should I enter? What opportunity am I missing? But preparation begins with a more demanding set of questions. What do I earn? What do I keep? What must I pay? What could fail? And how long could my financial structure continue operating if income were suddenly interrupted? These questions are not designed to create fear. They are designed to replace uncertainty with visibility. A fortress may appear impressive from the outside, yet remain vulnerable behind its walls. Its buildings may be valuable, while its reserves are low. Its income may be substantial, while its obligations consume nearly everything that enters. Its owner may appear prosperous, while depending on the next paycheck, sale, client, or refinancing decision to remain stable. The purpose of financial literacy is not to create the appearance of strength. It is to understand whether strength is actually present. A disciplined assessment begins with written evidence, income records, bank statements, recurring bills, debt payments, insurance costs, taxes, business expenses, savings, emergency reserves, and every financial obligation that continues whether conditions are favorable or not. Do not rely only on memory. Do not rely on impressions. Do not rely on what the account balance happened to show on one particular day. The market warrior builds a complete map, because what is not measured cannot be defended with discipline. Robert Kiyosaki's educational work repeatedly encourages people to pay attention to the movement of money and to understand the financial patterns shaping their lives. That emphasis can be a useful beginning. But the market warrior must go further. Every category must be verified. Every number must be current. Every assumption must be challenged. And every plan must be measured against the possibility that conditions may change. The first victory is therefore not profit, it is clarity. The fortress cannot be strengthened until its present condition is honestly understood. The next question is not simply how much money you earn. It is how money moves through the fortress. This is cash flow. Cash enters through wages, business revenue, contract work, rent, interest, distributions, or other sources of income. Cash leaves through housing, food, transportation, taxes, insurance, debt payments, business operations, maintenance, and the ordinary costs of life. The difference between what enters and what leaves matters, but timing matters as well. A person may earn enough over an entire month, yet still be unable to meet an obligation due tomorrow. A business may report a profit, yet lack the available cash required for payroll, inventory, rent, or taxes. A property may increase in market value, yet require continuous payments for financing, repairs, insurance, and maintenance. This is why financial appearance and financial strength are not the same. Net worth describes a position. Cash flow describes movement. Liquidity determines whether the next obligation can be met without selling something under pressure, borrowing at unfavorable terms, or disrupting the entire financial structure. These three ideas must not be confused. A person may possess valuable assets and still have poor liquidity. A business may generate revenue and still experience negative cash flow. A household may receive strong income and still remain financially fragile because fixed obligations consume nearly all of it. The fortress is not protected merely because money enters. It is protected when enough remains, when obligations are controlled, when reserves are available, and when the system can endure an unexpected interruption. To examine cash flow, begin with a defined period. 1 month is a useful starting point. Record every source of cash entering during that period. Then record every outgoing payment. Separate the necessary from the optional. Separate the recurring from the temporary. Separate the predictable from the irregular. Then ask, which expenses will continue if income declines? Which payments can increase? Which obligations carry penalties or collateral risk? Which costs are supporting productive activity? And which costs are simply consuming resources without strengthening the financial position? This exercise is not about shame, it is about command. A warrior does not condemn the battlefield for being difficult. The warrior studies it accurately. One of the most valuable lessons associated with Robert Kiyosaki's work is the insistence that income alone does not determine financial freedom. What matters is how the income is used, what obligations it must support, and whether the resulting structure creates greater strength or greater dependence. But this idea should never be reduced to a slogan. A high income can be managed poorly. A modest income can be managed with extraordinary discipline. An income-producing asset can still fail. A business can lose customers. A tenant can leave. An interest rate can change. A major repair can arrive without warning. Therefore, positive cash flow should never become an excuse to ignore risk. The market warrior examines the durability of the flow, not merely its existence. How reliable is it? How concentrated is it? How much does it cost to maintain? How quickly could it disappear? And what reserve stands behind it? Cash flow is not a promise. It is a movement that must be observed, tested, and protected. The market warrior does not ask only, how much can this produce? The warrior also asks, how much can this demand? And can the fortress survive when the answer is greater than expected? Few concepts associated with Robert Kiyosaki are more widely recognized than the distinction between assets and liabilities. The familiar teaching asks the student to observe the direction of cash flow. Does an item regularly place money into the financial system, or does it regularly require money to leave? As a teaching device, this can be useful. It forces the student to look beyond the purchase price, the appearance of ownership, or the expectation that something will rise in value. It asks instead, what is this item doing to my financial position today? But the market warrior must understand that there are two different lenses at work. The first is the cash flow teaching lens. Through this lens, an item is evaluated according to whether it contributes cash, consumes cash, or creates obligations. The second is the conventional accounting lens. In conventional accounting, an asset is something owned that carries economic value. A liability is an obligation owed to another party. These definitions do not automatically change because an asset is currently producing negative cash flow. A home may be recorded as an asset, while the mortgage remains a liability. A business vehicle may be an asset, even though fuel, insurance, maintenance, and financing create continuing outflows. An investment property may remain an asset, even during a period when vacancy, repairs, taxes, or debt service cause negative cash flow. The two lenses are therefore not identical, and they should not be treated as though they are. The cash flow lens asks, what is this doing to me financially? The accounting lens asks, what do I own? What do I owe? And what is the resulting equity or net worth? A disciplined market warrior understands both. One lens can expose the cost of ownership. The other preserves definitional and financial statement accuracy. Together, they create a more complete view. Consider a residence. It may provide shelter, stability, personal meaning, and possible long-term value. It may also require mortgage payments, property taxes, insurance, maintenance, utilities, and major repairs. Calling it only an asset may conceal the cash demands. Calling it only a liability may ignore its ownership value and the role it serves in the household. The stronger analysis asks, what is its current value? What debt is attached? What does it cost to maintain? How liquid is it? What risks can change those costs? And what purpose does it serve within the full financial plan? Now consider a rental property. It may produce monthly income, but the market warrior must also account for vacancy, repairs, management, taxes, insurance, financing, legal obligations, and the possibility that projected income may not arrive. The words income-producing asset do not eliminate these risks. They identify the intended function. The evidence determines whether that function is actually being achieved. The same discipline applies to a business. Ownership alone does not guarantee that the business is an asset strengthening the fortress. The business may depend completely on the owner's labor. It may have weak records, insufficient working capital, one dominant customer, unfunded tax obligations, or debt that continues whether sales rise or fall. The market warrior therefore asks not only, do I own it? But, what does it produce? What does it require? What can go wrong? And what remains if conditions deteriorate? No financial label should replace analysis. The word asset is not a guarantee. The word business is not a guarantee. The word investment is not a guarantee. The word passive is not a guarantee. Each must be examined through evidence, cash flow, obligations, liquidity, and risk. This is where independent thinking begins. Not by accepting every definition without question, and not by rejecting formal definitions because a different teaching framework sounds more persuasive. The market warrior compares the lenses, understands their purpose, identifies their limits, and then uses them together to see the entire fortress more clearly. A prepared financial structure does not depend upon one slogan. It depends upon accurate records, clear definitions, conservative assumptions, and the ability to survive being wrong. The fortress has now been mapped. The next question is how the warrior earns and how dependent each source of income may be. The fortress has been mapped. Now examine how income enters, how dependent it is upon your labor, and what may happen when that labor stops. Segment 2. Income in the Cashflow Quadrant. Robert Kiyosaki's Cashflow Quadrant presents 4 broad ways through which people may earn income: employee, self-employed, business owner, and investor. The framework can be useful, but only when it is understood as a map, not a ranking. It is not a formal accounting statement. It is not a legal business classification. It is not a tax determination. And it does not measure a person's intelligence, discipline, value, or potential. Its strongest educational purpose is to help the market warrior ask, where does my income come from? How directly does it depend upon my personal labor? What systems, assets, employers, customers, or markets support it? And what happens when one source is interrupted? A person may earn income from several quadrants at the same time. An employee may also own investments. A business owner may still work inside the company. A self-employed professional may employ a small team. An investor may maintain employment while gradually building capital. The categories describe income relationships. They do not permanently define the individual. The market warrior does not ask which letter looks most impressive. The warrior asks which income sources are reliable, which are concentrated, which require continuous labor, which can survive disruption, and which risks remain hidden beneath the label. Employee income is generally received in exchange for work performed within an organization. It may provide predictable compensation, training, benefits, professional experience, and a structure through which skills and capital can be developed. Employment should not be dismissed merely because it appears on one side of a diagram. For many people, It is the foundation upon which savings, education, family stability, and future opportunities are built. But dependence upon one employer can create concentration risk. A change in management, a reduction in demand, an illness, a layoff, or an economic contraction may interrupt the income upon which the fortress depends. The question is not whether employment is good or bad. The question is how prepared the financial structure is if that employment changes. Self-employed income may offer greater control. The professional, contractor, consultant, creator, or small operator may choose the service, the customer, the schedule, and the method of execution. But control does not automatically create independence. When revenue depends entirely upon the owner's personal labor, the individual may own the work, while the work still owns the individual's time. If the person stops, the income may stop. The market warrior therefore asks, can the activity operate without my constant presence? Are records current? Are personal and business finances separated? Are taxes and obligations reserved? Is there enough working capital? And can the operation withstand the loss of a major customer? Self-employment can be valuable. Employment can be valuable. But neither label removes the need for reserves, risk controls, and an honest assessment of income dependence. Within the cash flow quadrant, the business owner category points toward income produced through systems, teams, processes, and an enterprise that may continue operating beyond the owner's individual labor. That distinction is useful. But the word business does not prove that such a system exists. A company may have a name, a website, customers, and revenue, while still depending entirely upon one exhausted owner. A functioning enterprise requires more: accurate records, defined responsibilities, reliable delivery, cash management, working capital, customer diversification, insurance, compliance, tax preparation, cybersecurity, and contingency plans for disruption. A business is not independent merely because the owner hopes to step away. Its systems must demonstrate that independence through evidence. The market warrior asks, can the enterprise function without me for one day? 1 week? 1 month? Who makes decisions? Who serves the customer? Who controls the money? What obligations continue if sales decline? And what reserve protects the operation when the forecast is wrong? The investor category shifts the question from labor and business systems to the deployment of capital. Capital may be placed into stocks, bonds, funds, real estate, private businesses, or other assets with the expectation of future income or appreciation. But expectation is not certainty. Every investment carries risk. Income may decline. Prices may fall. Liquidity may disappear. Fees may reduce returns. Concentration may magnify losses. And borrowed capital may continue demanding payment even when the investment performs poorly. The title investor does not create competence. Competence must be built through study, due diligence, diversification, position sizing, liquidity, and the capacity to accept loss without destroying the fortress. Kiyosaki's framework often encourages movement towards systems and assets. The market warrior may study that objective without assuming that the right side of the quadrant is automatically safer, superior, or appropriate for every person at every stage. A stable occupation may finance education and reserves. Self-employment may develop expertise. A business may create systems and employment. Investments may provide another source of return. Each can serve a purpose. Each can also fail. The disciplined objective is not to escape one quadrant as quickly as possible. It is to understand how every income source functions, what it requires, what can interrupt it, and whether the combined structure strengthens or endangers the financial fortress. Income explains how resources enter the fortress, but it does not reveal what obligations may already control them. The next study is debt, leverage, and the cost of being wrong. Income explains how resources enter the fortress. Debt reveals who may already hold a claim against them. Segment 3. Debt, leverage, and the cost of being wrong. Debt is not merely money received, it is an obligation accepted. The borrower receives capital today and agrees to repay that capital according to defined terms. Those terms may include interest, fees, scheduled payments, a maturity date, collateral, personal guarantees, late payment consequences, and conditions that can change the cost of the obligation. Debt may be used for education, housing, business operations, equipment, real estate, or investment, but its intended purpose does not remove the obligation. The lender does not suspend payment merely because the original plan failed. The payment may continue when revenue declines, when a customer leaves, when a tenant stops paying, when repairs arrive, when the market falls, or when the asset cannot be sold at the expected price. This is the first discipline of debt. Separate the purpose of the borrowing from the certainty of the obligation. A borrower may believe that the debt will create income. The lender holds a contract requiring payment. Those are not the same thing. Before accepting debt, the market warrior identifies the amount borrowed, the true interest cost, whether the rate is fixed or variable, the required payment, the final maturity, every fee, every pledged asset, every personal guarantee, and every consequence of default. Do not study only the amount of capital received. Study the complete chain of obligations created by receiving it. Debt can provide access to time, property, equipment, inventory, or opportunity. But access has a price, and that price must be carried, even when the expected result does not arrive. Leverage means using borrowed capital, or another financial mechanism, to control a position larger than the capital initially committed. When the position moves favorably, leverage may magnify the result. When the position moves against the borrower, it may magnify the loss. This is why leverage can create the illusion of greater capability before revealing greater vulnerability. Consider an investment purchased partly with borrowed money. If its value rises, the investor may benefit from controlling a larger position. But if the value falls, the debt does not fall with it. Interest may continue, payments may remain due, collateral may lose value, additional cash may be required, and the position may have to be sold under pressure at precisely the wrong time. Leverage changes more than potential return. It changes the margin for error. A position purchased entirely with available capital may decline without creating an immediate repayment demand. A leveraged position may transform the same decline into a liquidity crisis. The market warrior therefore asks, how far can the value fall? How quickly could payment be demanded? Can the rate change? Could additional collateral be required? Can the position be held through adversity? And what happens to the fortress if the entire investment is lost? The phrase productive debt is sometimes used to describe borrowing intended to acquire an income-producing asset or expand productive activity. That intention may be reasonable, but the label must never replace analysis. The income may be delayed, the asset may underperform, the operating costs may be underestimated, the market may change, and the debt may remain fully enforceable. Leverage does not improve the quality of an idea. It increases the consequences of the idea being right or wrong. Before debt enters the financial fortress, it should pass through a survival gate. The first question is not, how much can I borrow? It is, what conditions must remain true for me to repay it? Begin with cash flow. What reliable income will support the payment? How stable is that income? How concentrated is it? What expenses must be paid before the debt? And how much remains after every obligation is satisfied? Then examine reserves. How many payments could be made if income stopped? What reserve exists for repairs, vacancy, inventory delays, legal costs, taxes, insurance, or an economic contraction? A plan that survives only under favorable conditions is not yet a resilient plan. Next, examine the terms. Is the interest rate fixed, or can it rise? Is there a balloon payment? Can the lender demand additional collateral? Is the loan secured by a home, business property, equipment, inventory, or personal assets? Has the borrower signed a personal guarantee? What happens if refinancing is unavailable at maturity? And what rights does the lender hold after default? These questions require the actual documents, not assumptions, not sales language, not a social media explanation. The contract governs the obligation. For business borrowing, the market warrior must also test the operation behind the debt. Can the business service the payment from existing cash flow, or does repayment depend entirely upon projected growth? Are financial records current? Are receivables collected on time? Is inventory moving? Are taxes reserved? Are customers diversified? Does the company possess sufficient working capital? And can it continue operating if one important assumption fails? Borrowing may help a business finance inventory, equipment, projects, or growth. But additional capital cannot repair an operation that does not understand its own numbers. Working capital must be managed, debt service must be measured, and expansion must not consume the reserves required for survival. The final gate is the cost of being wrong. Imagine that the expected income does not arrive. Imagine that costs rise. Imagine that the asset loses value. Imagine that the customer leaves. Imagine that the rate increases. Imagine that refinancing is unavailable. Then ask, can the financial fortress still stand? If the plan succeeds only when every assumption is correct, the debt is not supporting the fortress. The fortress is supporting the debt. A disciplined market warrior does not reject all borrowing, nor does the warrior glorify it. The obligation is measured, the downside is modeled, the reserve is protected, and the decision is made only after the cost of failure is understood. Debt has now been placed behind the gates of evidence, cash flow, reserves, and survival. The final discipline is deciding what to believe and what demands further study. The records have been opened, the obligations have been examined. The final responsibility cannot be transferred to a book, a personality, a platform, or a market. Segment 4, Independent Thinking. Independent thinking does not mean automatically rejecting conventional wisdom, nor does it mean automatically accepting an unconventional idea simply because it sounds bold, confident, or different. It means understanding the original claim, identifying the assumptions beneath it, comparing it with additional sources, examining the incentives surrounding it, and measuring the consequences before placing your capital, your credit, or your financial fortress at risk. Robert Kiyosaki's books and publicly available educational work may provide a useful starting vocabulary. Cash flow, assets and liabilities, income dependence, debt, business systems, investing, and financial education. But vocabulary is not verification. A powerful idea may still require qualification. A useful framework may still have limits. And a concept that works under one set of circumstances may fail under another. The market warrior therefore asks, what is the evidence? What definition is being used? What assumptions must remain true? Who benefits if I act? What could cause the plan to fail? And can the fortress survive if the conclusion is wrong? No respected voice should be exempt from those questions. Not a traditional institution, not an unconventional educator, not a financial personality, and not Sun Tzu trading. The purpose of education is not to replace one dependency with another. It is to develop the judgment required to stand independently. This field guide is not the end of the study. It is the opening of the archive. A market warrior who finds these concepts relevant may continue independently through Robert Kiyosaki's books, the official Rich Dad Educational Library, and his publicly available interviews, articles, and programs. Then compare the major claims with additional sources. Accounting standards, government and regulatory education, loan and insurance documents, business records, qualified legal and tax professionals, and evidence drawn from your own financial condition. Do not act merely because an idea is popular. Do not reject it merely because it challenges convention. Understand it, compare it, test it conservatively, and decide whether it belongs inside your financial fortress. The archive remains open, but the next move belongs to you. Study the flow, measure the obligation, protect the reserve, and never surrender your judgment. TZUtrading.com. Preparation before prediction. Enter the war room before your next move.